Welcome back to this month's Foguth Financial Client Connection. I'm Michael Foguth. This month, we're digging into a strategy that can quietly save you and successful investors a significant amount in taxes, and most people have never heard of it. It's called tax loss harvesting, and it works hand in hand with something called custom indexing. Joining us today is James Tietema, a financial advisor out of our Grand Rapids and Norton Shores office. Before we talk strategy, James is going to cover a few fundamentals, the building blocks, if you will, that make this whole approach make simple and easy to understand. James, take it away.
Well, thanks, Mike. I'm James Tietema. Thanks for joining us today. Today we're going to talk about a real complex topic, custom indexing with tax loss harvesting. Something to note when you're using a non-qualified account with your assets and trying to grow that is there's two different types of taxes you can have in those accounts. So there's short-term capital gains and long-term. Short-term capital gains is if you buy something, you have a gain in it, you sell it, and you've owned it for a year or less. Then that capital gains gets taxed as ordinary income, which could be a much higher tax depending on your income. So it goes on your income tax bracket. So if you're making a large amount of money and you're in a 30 plus tax bracket and you have a short-term capital gains, that's going to be a large tax event. If you own an investment for more than 1 year, it counts as capital gains, which is a much lower tax bracket to be in and a more favorable tax structure for you. I find clients I work with a lot with this custom indexing and the tax loss harvesting. Usually it's when they have a legacy position. They have a stock they've owned for 20, 30 years. You know, example, if you bought Apple in the 80s or 90s and you haven't sold it, there's a lot of capital gains that are built up in that stock. And what I say with capital gains is the growth, right? Your cost basis is how much you paid to buy it initially. So if I bought it for $10, my cost basis would be $10. And then over time it grows, and you know, Apple's almost $300 a share now. So that's a lot of gains you would have over those years. If I want to sell and create some income for myself, that's a lot of capital gains tax I'm going to pay. So using this indexing strategy, we can bank some of our losses over the years, and that can help you get out of the large legacy position, kind of unwind it slowly over time. And that really helps you be able to change strategies or create an income from, you know, long-term investing, those type of things. Custom indexing, if you think about it, most people own mutual funds or exchange traded funds, ETFs, and there's a bunch of stocks in there. It goes up and down. If you sell it, you're selling all of the stocks in the index. The custom indexing, we actually own the individual stocks. So that allows us to sell one stock or multiple stocks in that index. And that's how we get into the tax loss harvesting portion of it. The tax loss harvesting comes from an index, example, Russell 3000. There's 3,000 stocks in that index. Even in a great year, market's up 20, 30%, there's going to be a handful of those stocks that are negative on the year. We can sell those, create losses, and that goes against the gains that you have. You still participate in the growth overall of that index, but your tax liabilities get reduced. This strategy works best in your non-qualified accounts because those are the accounts that you're going to pay every tax available, right? If you have a retirement account, some taxes are excluded at different times, so the tax loss harvesting really doesn't benefit you as much. But the non-qualified accounts, just a regular brokerage investment account, this strategy works very well in those type of accounts.
This month, Foguth Financial Group hosted an exclusive client appreciation event at the Detroit Institute of Arts. What an amazing night. This event was just a simple way for us to celebrate every client who referred a friend, family member, neighbor, coworker, somebody important in their life to us in the year 2026. We had private access to the entire Detroit Institute of Arts Museum and an unforgettable dinner inside of the Great Hall. Tell you what a great night. Thanks to everyone for being there. If you were not at our Peace and Purpose Summit that we had the other month, you may have missed some huge news. Foguth Financial Group has officially become the wealth management partner of Eastern Michigan University Athletics. I'm telling you what, how cool is it? We got 2 major Division I programs and their entire athletic departments right here in the central state here of Michigan. Incredible honor and an opportunity to be able to provide peace and purpose to all of those student athletes, alumni, fans, guests. What a great opportunity that we have to take place with Eastern Michigan Eagles. This month, our team also participated in Michigan's Adopt a Highway initiative. Wow, what is this? I'm telling you what, if you ever drive down US 23 heading south, right by Lee Road, you're gonna see a beautiful sign and a beautiful highway, because our team was out there. Dozens of team members volunteered, cleaned up both sides, the middle. I don't know how you did the middle. It's kind of like playing chicken, but we got it done, both sides, the middle. Thanks to every one of the team members at FFG for keeping our highways clean and maintaining that 2-mile stretch. It all adds up at the end of the day. Now, James, back to you.
Hey, thanks, Mike. We talked a little bit about what tax loss harvesting and custom indexing is. What I want to do now is go into some scenarios that I'm working with current clients with and how it's helping them. So the first scenario I'd like to talk about is a legacy position. Clients have a little over $4 million in a non-qualified account. They own 6 different stocks. So they are very heavily concentrated. They've owned those stocks for many years, and it's almost all capital gains. If they sell anything, they're going to pay the maximum amount of capital gains that they can to own those stocks. The other part is those stocks are giving dividends and interest, and that's a taxable event each year in a non-qualified account. So they were getting near a $50,000 a year tax bill with holding those investments because they've grown so large. Using that indexing strategy and getting the tax losses in there, we're able to slowly sell those positions and then reallocate them into more tax efficient investments. So it's not an overnight success, but over time, we're going to chip away at those gains that they're getting every year. And hopefully one day we'll get it down to no capital gains distributions or values, no capital gains in their investments. So currently they're not using this portfolio for income, so it's really just a tax bill that they're getting every year for doing nothing. The second scenario is a client has about $600,000 in non-qualified accounts that are in mutual funds. He started investing 20, 25 years ago. More tax efficient strategies didn't exist back then. That was really the only way he could invest. And he has great mutual funds that are performing very well for him. But he gets $20,000 in capital gains distributions from his mutual funds. And that's more of a complex topic. If you think about a mutual fund, there's a mutual fund manager in there buying and selling, trying to do the best he can for the people that own his mutual fund. Well, in a non-qualified account, every time he sells at a gain, that's a capital gains. And at the end of the year, that mutual fund gives a capital gains distribution to him. And he was getting about $20,000 a year. The other thing that was happening is that pays dividends and interest in the mutual fund, and he was buying new shares. So his problem is growing. He's owning more and more of the mutual fund, so his tax distribution or capital gains distribution at the end of the year is just going to compound and get bigger. Using the direct indexing tax loss harvesting program, we're able to start allocating that cash to the program. Sold a little bit. We had to take a little bit of a hit up front to get him out of that position and start the tax loss harvesting. But over time, we're going to be able to reduce that position and reduce his taxes and get him into more tax efficient investments so he doesn't have that issue anymore. In our custom indexing strategy, we have many different types of indexes you can get into. There's over 50 different indexes, so we can really tailor it to the individual risk tolerance of an individual, whether you want to be all in growth stocks or you want to have a more conservative approach. We can still use this strategy to help you and help you get out of any tax problems that you might be coming up to.
Taxes are one of the biggest drags on long-term wealth. But with the right strategy, they're also one of the most manageable things inside of your portfolio. So if you're sitting in a highly appreciated position, maybe a large non-qualified account or a future sale on the horizon, now is the time to jump into a conversation and reach out to our team or go see James directly out in our Grand Rapids or Norton Shores office. So folks, thanks so much for joining us this month. Foguth Financial Group Client Connections is here for you, and I'll see you next month.